But from all the secondary market action, let's talk about the primary market because there's a new issue out there. BlueStone Jewellery's IPO is opening up. It's an issue which is a little over 1,500 crores, 1,541 crore rupee IPO to be precise. It opens out for subscriptions today. The price band has been set at 492 to 517 rupees per share. The company has raised just under 700 crore rupees from anchor investors. So let's talk about the business and the prospects with Gaurav Singh Kushwaha, Chairman and Managing Director, and CEO Rumit Dugar, Chief Financial Officer at BlueStone Jewellery and Lifestyle. Gentlemen, thank you so much for joining in, and good to have you with us. I can say, I've been a customer already. So I have two straight questions. One on the losses, because while the company has been growing very, very well, you've exhibited 50% growth. It's, fashion jewelry, jewelry for the modern woman, etc. That's been the positioning. Losses have continued. That's one part. The other question that I had was actually on what happens to the IPO, because there's been some chatter and some conversation that apparently there is a case that's been filed in the Securities and Appellate Tribunal, making some allegations on disclosures, etc., things like that. Where does that stand? And could it impact the IPO? I don't know what's happening at SAT. So if you could just clarify.
Sure, let me take that. So on the SAT case, there was an appeal that was filed by one of the litigants. That appeal, there has been multiple hearings that have happened. The appeal has not even been admitted yet, and we've got all the requisite approvals. So absolutely, there is no impact on the IPO.
And on the losses part?
Yeah, sure. So on the losses, look, I think the business has seen tremendous amount of growth. We've been investing quite aggressively in the business to build scale. As you can see, we have almost 275 stores. And we are at a point in time, if you look at our EBITDA margins are already close to 7%. And a lot of the capital investment has gone in the last 2 to 3 years. And thus, we are coming to a market at a time where a lot of the investments have gone. The growth is still very high. And thus, there is tremendous amount of operating leverage that is flowing in the business.
Morning, we're calling it KYC, Know Your Company. So Ruby knows the brand. For those who don't know the brand, Gaurav, if I can request you to just tell us a little bit about the business itself.
Sure. So we started as an online-only jewelry brand, and for 7 to 8 years, we were largely online only. I think at that time, we realized a very peculiar user behavior where people are finding it very comfortable being able to browse so many pieces of jewelry sitting at home. But I think given the nature of the category, given the price point, given gold, diamond, etc., there was a push from customers that, okay, we also want to see it in person, physically before completing the purchase. So while online was doing its job of pulling in people in droves, and see, online in a way is a much better it's much better at letting people browse jewelry, because that is something you cannot do in offline stores. And so essentially that worked very, very well for us. And the ask from users was to allow them to also see it physically before they could buy it. So we started opening stores, and we are very young to it. So FY19 was when we opened our first store. We opened 5 stores in that year, then 11, and so on. So and we saw tremendous success, and that's why we started increasing the store presence exponentially. And that also links back to some of those questions about losses, because those early stores are extremely profitable. But what happens is, because it's only been 5 to 6 years since we started opening the stores, the ramp is like this. And most of the stores are sitting in a very, very young cohort. But they're all showing very strong SSSGs. So if you look at same-store sales growth at a blended level also, that's 30% plus, which is kind of unheard of.
How many stores do you have now?
275.
Across, in terms of...
Across 117 cities, across all geographies. In fact, another beautiful thing is in this category where most of the players are very zonal, very regional, we are among the two who are naturally national.
In terms of the split of products that you sell, how does that, gold and...
So almost 67% of our sale comes from studded jewelry, which is gold with diamond or gemstones. And 30 to 35% is from plain gold jewelry. And we also, as a consequence, we also have industry-leading margins. So our gross margins are to the tune of 37-38%, which are, again, so our growth and margins both are unheard of in the industry. And I think those losses are a result of some of the front-loading of investments that we've done.
All right. Hi, gentlemen. Good to have you all in the studio. Looking forward to interacting with you all, on a quarterly basis, at least with regard to your results. And maybe since you'll be given that push, visit one of your stores as well. That said, where do you all turn profitable?
So, I mean, that'll be a forward-looking statement, obviously. So we are constrained by that. But what we can tell you is the business momentum, as Gaurav mentioned, is pretty strong. We've grown at about 50% CAGR for the last 3 years.
Okay.
A lot of the capital employed in the business has gone in. If you look at some of our older cohorts, they generate about 24% store-level EBITDA, which is something that's part of the disclosures. And there is no reason for us to believe, given the kind of growth momentum we are seeing, that there should be any difference in the younger cohorts.
All right. So you'll have cut out the path towards profitability is what you're telling us. And once you list, then I'll push you a little bit more on that point. Got that out of the way. But if you could help us out with, your margins as well. If I look at ad spends as a percentage of the sales mix, it's relatively higher in comparison to the industry peers as well. Where does this number settle at?
So, look, in terms of A&P leverage is pretty high, and it's a function of what is the size of the revenue base. So, if you look at some of the larger brick and mortar peers, the revenue bases are much higher. Thus, as a percentage of A&P, it keeps coming down. So, there is reasonable amount of operating leverage that is sitting on the corporate costs and A&P. We've seen those levels come down from about 12% 2 to 3 years ago to almost 9% last year. So we're seeing that continued trend of scale driving a lower A&P.
I just want to check on this number. A colleague was telling us that as of now, if we talk about total revenue, then online is giving you about 15% of your total revenue as of now. Would that be right?
No, so, okay, the way we see our business is we don't see online and offline channels separately. So all our journeys, all our users start their journey online. Some of them are comfortable placing the order online also. But for most of those people, they actually are more comfortable once they have shortlisted online to walk into a store and then convert. And just to put it in context, this is like pretty much buying a car. You can do all your research online while buying a car, but you won't click a buy now button.
No, absolutely. That's philosophically, how you've seen the business.
In terms of invoicing.
But I'll tell you, go on.
In terms of invoicing, that number is lower than 15%.
Yeah, it's about 6 to 7%.
6 to 7% is actual purchase happening only online without the store walking.
That is invoicing online.
Invoicing online.
What also happens, Surbhi, is that if, let's say, because we are an omni-channel player, if you place an order online and that product is sitting at a store which is 2 kilometers away, it'll get delivered from a store.
So the reason
it'll reflect in store revenue.
The reason I'm asking you is very, very simple. If it was, if the bulk of it was happening purely online and there's no need for physical stores, obviously it's great for profitability and margins, right? That's not the case. I was a customer who came in who was a walk-in customer, didn't even bother checking online. So as your store count keeps increasing, and you'll do a blend of mix and match of both styles, what's an aspirational, and I'm not even asking FY26 or 27, I know you can't talk about that, but give us a directional aspiration. Where should EBITDA margins settle at once stores have matured, once the model has matured, say 3 years down the line?
So I think the best way to kind of look at it is how my older cohorts are performing. My older cohorts, which are at a 10 crore revenue productivity at a store level, deliver a store level EBITDA margin of 24%.
Okay.
Right? So that, and that happens at a 10 crore productivity, right? So unlike big box, we don't need a 40, 50, 60 crore store productivity to deliver a 23, 24% store level EBITDA. We do it at a much, much lower revenue threshold. And the reason for that is our gross margins are close to 38%. So directionally, that's the performance.
20% plus could be an achievable target a couple of years down the line, not immediately. Okay. Can't say much.
I can't say much.
I just have to ask the lab-grown diamond question. Is there a threat? Because that's
we don't see that playing out in the smaller diamond categories where our majority plays. So essentially, diamond category also, there are two types of customers. One is solitaire customer, other is people who buy designs that also happen to have diamonds. And those diamonds are very, very small diamonds. So typically what's happening is the lab-grown impact is being seen in the solitaire space, be it US, be it India and so on. And I think Titan also in their multiple commentaries has revealed almost the same thing. In case of smaller diamonds, there's hardly any cost advantage of lab-grown and hence there's hardly any momentum in that particular space.
So you're not looking to go big on
And solitaire is only 2 to 3% of Indian market, right? India is not a solitaire heavy market like many of the Western societies. India is more like design market. We have jhumkis, chandbalis, plenty and plenty more of.
So you're not looking to really push on the lab.
We are not.
All right, gentlemen, we'll leave it there for now. Thank you very much. And hope to speak with you on the day of listing. And of course, we'll have many more conversations after that. Good luck.
Thanks, Prashant.
Thank you.
Thanks.